every Monday to Friday. This is Peter Lewis's Money Talk. Money Talk.
Good morning and a warm welcome to Money Talk for Wednesday the 4th of October. This is Peter Lewis. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. And thank you for making us one of the most listened to financial podcasts every weekday in Hong Kong and Singapore. If you want to get in touch, then please go to my website, peterlewismoneytalk.substack.com. I'm also on Facebook, Peter Lewis Money Talk is the page, and on X, you can find me at Money Talk R3. In today's business and finance headlines, the Reserve Bank of Australia left its cash rate on hold for the fourth consecutive month at an 11-year high of 4.1% in the first meeting under new Governor Michelle Bullock. Interest rates have increased by 4 percentage points since May last year. Tuesday's move was in line with market estimates, with the board again saying inflation had passed its peak, but it was still too high. US House of Representatives Speaker Kevin McCarthy has been forced out of his role after a vote by lawmakers. Republican Representative Matt Gaetz of Florida moved to remove Mr. McCarthy from his post as retribution for cooperating with Democrats over the weekend to avoid a government shutdown. Lawmakers debated the leadership challenge and then voted 216 to 210 to oust him. Mr. McCarthy is the first speaker in US history ever to be removed in this way after a motion to vacate. India and its South Asian neighbours are expected to grow faster than any other developing country region this year, the World Bank said, with robust growth defying gloomy outlooks for China and much of Asia. The World Bank on Tuesday raised its 2023 forecast for growth in South Asia, which includes Pakistan, Bangladesh and Sri Lanka as well as India, to 5.8% for 2023, thanks in part to its young and growing population. Demand for US workers unexpectedly rose in August, fueling expectations that the Federal Reserve will keep interest rates high for an extended period. The number of job openings rose by 690,000 in August from the previous month to 9.61 million, well above market consensus of 8.8 million, and indicating a robust labour market. The number of job quits increased by 19,000 from the previous month to 3.638 million in August. On today's programme, I'm joined by Enzio von Pfeil, Capital Preservation Specialist at Financial Shield, and John Schofield, Managing Director of Tempus Investment. And later in the show, I'll chat with Nick Smith, Japan strategist at CLSA in Tokyo.
Peter Lewis's Money Talk.
On Wall Street, US stocks slumped Tuesday as bond yields surged following the strong JOLTS data. The Dow turned negative for the year, tumbling 431 points or 1.3% to 33,002 in its worst day since March. With Tuesday's losses, the Dow went into the red for the year. It's now off by 0.4%. The S&P 500 slid 1.4%, touching its lowest level since June during the session and closing at 4,229. The S&P 500 is still up 10% though for 2023. The Nasdaq Composite dropped 1.9% to end at 13,059. Meanwhile, the VIX Volatility Index, known as Wall Street's fear gauge, jumped over 12% to 19.78. That's its highest point since May. In the Treasury bond market, the 30-year US yield reached 4.95% for the first time since 2007, before the financial crisis. The 10-year yield jumped 12 basis points to a new 16-year high at 4.81%. That's the highest since August 2007. And the yield curve inversion reached its narrowest since March, hitting minus 34 basis points on Tuesday. The spread exceeded minus 100 basis points as recently as July. Sovereign bonds elsewhere were also swept up in this week's global sell-off. UK 30-year gilts rose above 5% for the first time since the UK's pension crisis last autumn, which sent long-dated gilts into free fall. Yields on German 10-year debt rose by 6 basis points to 2.98%. That's a 12-year high. The Italian 30-year yield reached its highest level since 2012 at 5.45%. And yields on 10-year Japanese government bonds hit as much as 0.79% Tuesday. That's its highest since September 2013. The Japanese yen briefly breached the politically sensitive 150 yen against the dollar for the first time in nearly a year, breaking that psychological barrier that's triggered intervention by Japanese authorities in the past. The US dollar yen rate then plunged nearly 300 pips within a few minutes, sparking suspicions of intervention. On Tuesday, the yen traded as low as 150.16 against the dollar before ending the session 0.8% higher at 148.81. In emerging markets, the Chinese yuan was flat at 7.3219 in offshore markets. Mainland markets are closed until the 9th of October. Shares in Hong Kong led the Asian region lower. The Hang Seng Index plunged 2.7% or 478 points to an almost 11-month low of 17,331 after traders returned from Monday's public holiday. The tech index tumbled 2.6%. The Hang Seng Mainland Properties Index dived 3.6%. And doesn't look like it's going to get any better at the open this morning. Futures markets are pointing to another decline of about 50 points. That's a third of a percent. Looks like the index should open around about 17,280. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Well, as we get back into this swing of things in this shortened holiday week, let's welcome our Wednesday commentators. First of all, we have our regular Wednesday guest, Enzio von Pfeil, Capital Preservation Specialist at Financial Shield. Morning, Enzio.
Morning, Peter.
And also with us, John Schofield, who is Managing Director at Tempus Investment. Morning to you, John.
Yes, hello, good morning, Peter.
Now, as you heard there in the market rundown, the rout in US Treasuries has intensified and US stocks also lost ground as traders are digesting messaging that the Federal Reserve intends to leave interest rates higher for longer to rein in inflation. Yields across the curve jumped to new multi-year highs on Tuesday. Another thing to just add to that, the average rate on a 30-year fixed mortgage jumped to 7.72% on Tuesday. Mortgage rates haven't been that high since late 2000. Enzio, is this justified, this rise in yields, do you think, by the fundamentals?
Well, I think it is because the global economic time, but very much because of the US, I think is changing from an excess supply of money. It's funny dawning on markets that actually there's going to be an excess demand for money going forward because the Fed has been physically tightening only since about April of this year. So I think that's beginning to dawn on them. And also just simply the fact that the yield curve does remain inverted. The 2-year at 5.15, the 10-year at 4.81 means there's still a 4% difference. So that would be heralding a recession, which is, of course, then ultimately has to be lower earnings in the U.S.
John, is this justified, do you think, by the fundamentals, this move in rates? Not just in the US, is it? It's around the world, but presumably it is the Fed that's leading it. It's US rates leading the way, isn't it?
Yes, for sure. I think there are 2 or 3 factors driving the higher bond yields now, as opposed to short-term rates. The fact is the US economy continues to be quite robust and quite healthy. But at the same time, the Treasury, there are a lot of Treasury bonds coming onto the market. So there's a sort of supply, just a sheer supply thing.
Almost $1 trillion in the last quarter. That's a phenomenal amount, isn't it?
Yeah, that's right. And as Andy said, tightening goes on, i.e. the runoff of the Fed's balance sheet goes on at a steady pace. We don't hear the talk of that, but it basically means that every 90 billion a month, I think it is running off that balance sheet, which is now well below 8 trillion, having started life about a year ago at 9 trillion. So that's ongoing, but probably a side issue. But the justification for having an inverse yield curve is always that a recession is around the corner, and everyone now doubts that. Clearly, ironically, it may be that these higher rates for longer do eventually trigger some sort of a recession, but that's purely that's depends on forecasting, which is inherently uncertain.
And the carnage really got going today after the release of the JOLTS data, the job openings survey, showing far more jobs available than initially estimated.
Yes.
And also the quits rates went up, quits always go up when people are confident, aren't they, about finding another job.
Well, also third generation stuff, maybe they just don't want to work. I think that there are a lot of supply driven inflation motors that the Fed simply cannot address with its myopic focus on demand driven inflation. Supply side factors would be people not wanting to work. So of course you have higher quit rates, you have tight labor markets because people just don't want the jobs. The politics of oil leading to phony supply shortages, the sunspots and El Nino leading to crop shortages. So these are things that are going to keep those Fed funds rates pretty high for a long time. But because the Fed is kind of trying to repair its Mercedes-Benz with knitting needles, and it's just not going to work.
But it does challenge, doesn't it, the prevailing wisdom that the employment picture was loosening on previous data. And if it's not, then presumably it's not just about how long do rates stay at these levels. It's maybe more rate hikes are on the cards if the labour market remains this robust.
Well, we've been. I mean, we get many of these things wrong also, as everybody would. But one of the few things where we have been pretty good is with looking at the Fed funds already back in March of 22, looking at them reaching more 6% than at the prevailing 4% at the time. So I still stick with that. That I think that again, but because for all the wrong reasons, they will keep on hiking the rates as opposed to increasing the supply through the middle class education system, for instance.
But people talk about high rates. But actually, by historical standards, these rates are not high, are they? I mean, it's just that we've been used to ridiculously low rates in the years since the global financial crisis, even negative rates in some cases. But these are not high rates by historical standards, are they?
No, but relatively, they've doubled. So the mortgage is 3.9%, which is what the bulk of the mortgages in the US are now. They're double. So I agree with you. In our collective histories here at this table, we're a little bit more the senior set these days, and that's of course we've seen much higher rates, 19% back in the 70s, but I think it is still a doubling.
John, this is going to be the issue, isn't it? We've got to get used to now this normalisation of rates. We're certainly not going to go back to zero, unless you're in Japan maybe, but outside of Japan, we're not going to have zero rates again, are we? We've got to get used to a normalisation, and there's going to be consequences of that.
Yes, I mean, what's going on right now is partly a repricing of assets in line with, as you say, the new normal and new reality. Don't forget, we're coming to the end of a 40-year bull market, as it were, in bonds. It came to an end about a year ago. So, from a chartist perspective, you can expect a 10-year bear market possibly in these instruments. I don't want to get too far ahead of myself, but that's so what's happening right now is people now they're pricing off short-term interest rate, risk-free interest rates of 5.5% in US dollars. So every other asset has to stack up against that and provide a margin, a positive margin, a risk premium, I should say. So where the bond, if interest rates stay at 5% plus for a year, bond yields are going to have to go, or also going to have to go up to 6%, or even, as Jamie Dimon says, 7%.
Right.
Over it.
It's going to have a big impact on equities, isn't it? Because you've got to reprice equities.
And then above that, you've got to have a premium, an equity premium, because we're still talking risk-free. It's a 10-year rate, it's still risk-free. Equities obviously are fraught with risk. There will be interludes, of course, so nothing goes in a straight line.
How much of this, I mean, obviously the economic fundamentals are one of the drivers behind it, because, the US economy is still looking pretty robust, isn't it, despite fears of recession. But the other aspect to this is government borrowing. The US is running a budget deficit of about 7%. Where outside of a recession, that's actually very high, isn't it? And that's got to be funded through all this Treasury bond issuance. So presumably that's also another major factor here, another driver.
Yeah, on top of that, I fully agree, is also just the congressional sort of shenanigans of then throwing out McCarthy and extending the budget deadlines, and the place just doesn't seem to be run anymore, frankly.
And has this all got ahead of itself, though? Are we now sort of is this bond market route maybe got out of kilt with the fundamentals? Because it's you're getting some extreme readings, aren't you, in things like momentum and sentiment for some of these bonds, massive volumes in Treasury bond ETFs. I'm just wondering, when you start seeing things like that, you then suddenly get a massive reversal.
I don't think so, because I just think that the markets still expect these rates to be cut next year, and so they're going to be on the futures, what you pointed out this morning in your notes, Peter. So that means that the markets are still going to be in for some very, very deep shocks. So I think the markets are kind of in delusion land, wanting to believe they've got to cut the rates next year, when in fact the Fed has been saying quite the opposite for quite consistently for a change.
John, what are the consequences of this? Because there are some, aren't there, that we got to think about. I mean, first of all, for companies, we're coming up to third quarter earnings reporting season, just around the corner. But companies have got to take this into account now, haven't they? That they're going to have to refinance when they need to at much higher rates than they've been financed before. This is going to eat into earnings pretty rapidly, isn't it?
Well, some companies are in a position of sitting on large amounts of cash, particularly big tech, Amazon and so on. They've got huge. So for them, it's not bad news. They can just receive the interest rates. But yes, for the smaller companies, and you see this in the performance of the various indexes, the Russell 2000, the small cap index is really in a proper bear market, I think, whereas the Nasdaq, for example, is only so far anyway just a bit of a correction. So they're going to be winners, and they're going to be the relative winners, I should say, and big losers. The banks might be quite happy as long as they don't have too many bad debts.
Well, I was wondering, on the banks issue, we saw back in the summer, didn't we, that when there was a big move in bond yields, then, as Warren Buffett famously said, when the tide went out, we found out who wasn't wearing a swimming costume, and some of these banks got into trouble. Do you think is there a risk of that happening again with banks? That they've got huge bond portfolios, some of these banks, haven't they, which they've got to mark to market.
Yes, I don't know how all those that had those, but I don't know how far they've got off got along in restructuring. And again, a bit like the Fed, maybe running off stuff. Hopefully, they've got the duration right down as far as they can. That may be one reason for the sell-off. Actually, they're trying to get the duration down. So you can sell a 10-year bond and put it into short-term paper or 2-year bonds, and make a positive spread that way.
But the banks, if they have to cover their losses, then they've got to issue more equity, haven't they? And that in turn becomes dilutive to the share price.
Yeah.
What about hedge funds? We always tend to find at a time of severe market moves, there's also some hedge funds caught with their pants down as well, aren't there? There's a lot of bond hedge funds out there, a lot of macro hedge funds that run large bond portfolios. That's another area, presumably, that we've got to watch closely.
Yeah, there's something, Peter, that maybe you can explain a bit better because you're years of experience, but I read something about the basis trade. Is that a big risk in markets? Because you were at the sharp end of the stick on that kind of stuff.
It could be, particularly if the market is illiquid, because it involves a lot of borrowing. You go and borrow basically money in the money markets, and then you put on the treasury basis trade where you sell futures and you buy bonds, or vice versa, and that's all done through leverage as well. So what is just tiny movements, tiny basis point movements
really
in this trade really gets magnified up because of the borrowing on both sides of the trade. I
just wanted to get back to this illogical thinking in the market, because it's worried me for some time, which is that on the one hand, the Fed says, well, it's all demand-driven inflation that we're trying to fight, so let's keep jacking up the rates. And then at the other end of the stick, we've got a an inverted yield curve, suggesting at least that at some point the steam is going to go out of the market. And then you've got the market itself saying, well, actually, they're going to be cutting rates next year. They've been quite adamant about that. I'm just concerned that the market's kind of getting it all wrong yet again.
Well, they've been fighting the Fed all year.
Yeah, fighting
they?
the Fed,
and,
that's it.
And have been wrong to do so all year as well, because the debate is certainly not about lowering rates next year amongst the Fed. It's about how high to keep them, or how long to keep them at these high levels. They're not talking at all. I can't see any Fed policymakers coming out and talking about cutting rates.
No, it's a bit like China. If you're all of a sudden on side with China, then you're sort of in the bad camp. So if you're a Fed guy talking about cutting rates, so that's just a no-no.
What about the consequences for consumers? They're going to feel the squeeze here, aren't they? Mortgage rates are going to go above 8% fairly soon by the looks of it. Credit card loans, personal loans, lending standards, all tightening in the third quarter. How much of an impact is this going to have on the consumer?
I don't have any data on what percentage of U.S. mortgages are still at 3.9%. I know that Sharma in the FT a couple of days ago mentioned this, that the average mortgage rate is still 3.9%. In other words, it's not gone up to the 7ish or 8ish%. But I don't have a grip on what percentages of these. I suppose credit card debt would be variable, but the mortgages, I would have thought a hefty chunk is still pretty much in the fixed rate 3.9%. But that's open to debate.
Yeah, well, one of the issues is wages have kept up more or less with inflation. That's why we haven't seen the consumer, particularly in the States, cutting back much, or in the UK and elsewhere. People have still got accumulated savings. I beg your pardon, from COVID times. I've also read that that's about to run out in the case of the US, but in the case of the UK, for example, there's still quite a lot of personal savings in the banking system, which are still being spent. Hence, the UK, for example, hasn't plunged into a recession. On the mortgages, of course, the US had the advantage of 30-year mortgage. It has caused a slowdown in house sales and resales. People who just want to sit on their 3.9 mortgage if they move to a new house. They'll have to pay 7 or 7.75 apparently. But if they get a big enough discount, some people will be, and they have good earnings, and some people will be willing to do that.
And the other area we've got to look at is the government itself. It's got public debt at 120% of GDP, a large budget deficit. It's got to carry on sort of financing. The interest costs for the government are going up rapidly, aren't they?
Yes, for sure. I mean, they're not having any difficulty. They won't have any difficulty financing it. I mean, the Treasury market is the biggest and most liquid by far in the world, and that itself is. And there are plenty of people who will be attracted. I think right now we're just going through a step change where the rates will go, they'll go quickly to 5 point something. Let's say in the case of 10-year. And then maybe pause, but I still think the issuance will be taken up by the market. A lot of investors have accumulated huge amounts in money market funds. At what point are they going to be tempted out from the short-term money market instruments to lock in something slightly, for a longer term?
Probably when the banks go bust because they can't keep all that cash going because they're doing lending.
A lot of it goes into T-bills, the short end of the curve. So, and CDs and what have you. So that's.
And what about the US? What about the US dollar? What's the implications here for the currency? The US dollar index now at its highest level since November. The yen seems to be the main casualty here, doesn't it? Breached 150 briefly yesterday, but it does look like the Japanese Ministry of Finance was intervening because there was suddenly then this huge rally in the yen. But presumably, as long as you have this massive differential between Japanese bond yields and US Treasury yields, the yen is going to continue to suffer.
Yes, I mean I think that was a bit of a spoof, frankly. that move yesterday in the yen. Everyone is, and the yen's actually the exception to the fact that all the major currencies have been sliding against the US dollar, and the fact the index still hasn't got to as you say the peak last year, last November, may mean there's some more to go. So on the one hand, as you say, there is a potential supply problem with treasuries and all the rest of it, but the reality is that US the returns people can earn on US assets, whether equities or bonds, is greatly superior to almost anywhere else. So that's bound. So in fact, the US is sucking in investment into the dollar. The yen is it's an interesting game. They yesterday the BOJ said, well, actually, or the Ministry of Finance rather, actually we're looking at is volatility, and as long as the yen is not moving independently weaker against the other currencies, which it has not been, then the implication is that they won't intervene. They will only intervene if the yen is specifically targeted.
But it looks like they did, didn't it?
But the market is still well, that could be a spoof from some hedge fund trying to be clever, and just catch out. There's a lot of long positions in the futures markets and so on. The yen, short yen, long dollar, so it's very easy to trigger a bit of short covering.
And what about equity markets? Over here, the Hang Seng down 2.7% yesterday. It's at an 11-month low now. Is that also a consequence of these bond yields rising, or are there other specific local factors going on?
I think there are a couple of... It's very much, of course, where the US goes, the rest of the world generally follows. I mean, the economic time in India and Vietnam is, of course, very different, as we know, and also Japan. But I think also just my swan song on China, which is that, and I'm not alone with this, that many commentators and many newspapers also are wondering whether this squelching of the private sector is going to really create the jobs that China gets. And of course, we're the water ski off the back of the Chinese speedboat.
There was optimism that maybe when China reopens, we could see a bit of a rebound, because the government has taken some measures to try and support the economy, and the economic data that's been coming out more recently does tend to suggest that maybe the worst is over for the economy. Would you agree with that assessment?
Just because it's bottoming doesn't mean it's going to go up. So even if there's some stabilization, also off the back of base effects, in other words, of raunchy numbers of last year, so it looks less terrible than it was, and that it's not being factored in. I still just think that the overall employment outlook, and ultimately any economy hinges on consumer sentiment in my mind, because it's such a big chunk of the economy, whether directly or indirectly through the property sector, that's still getting hit, and the people just feel less confident, one, because they're not getting a job, and two, because their properties have gone fat.
But the local markets were tumbling before this latest bond round, weren't they? We had the last quarter, in the third quarter, the Hang Seng down almost 6%, the world's worst performer among the major markets. And similarly, Chinese markets, mainland Chinese markets, not doing much better. The Shanghai Composite down 3% in the third quarter. These markets have really been in the doldrums for a while now, haven't they? What's it going to take to get them out of this?
The only way out is to allow the private sector to start creating jobs again. Until that happens, which I'm not seeing myself, and many commentators are, at least on my side, quote unquote, or I'm on their side, that's just not going to happen for a long, long time. So that's my concern about China.
And we're not even getting the data, which is going to help us decide whether jobs are being created.
We won't get the US data either.
It's being suppressed, isn't it? We're not seeing, for example, the youth unemployment number anymore. So we're missing important information about, is China starting to create those jobs that you say are needed?
Well, important always to remember that also most of the data that we get are only for China's urban population, not for the 800 or 900 million rural people floating about.
John, what are your thoughts about the local markets here?
Yeah, well, I think the background of the property crisis, China property crisis. I mean, to me, seeing some resolutions in that, that's almost a necessary condition for a market recovery. Whether it's sufficient, but that may not be sufficient if as Enzio says, the rest of the economy is still flat on its back. I mean, the one sector, of course, that is in good shape are the manufacturing exports. At least the big ticket items like the EVs, solar panels, etc. But even that, so we're going to see a flood of EVs coming out, targeting Europe especially.
They're not going to be happy.
The German car industry is quaking in its boots. So the EU is going to start an investigation on whether it's fair trade. So
well, they got whacked with the solar panels, didn't they?
Yes.
So because the Chinese were dumping,
didn't help.
The Chinese aren't ideal either. So
it didn't help the indigenous manufacturers. They've already been
absolutely
pretty much wiped out.
Yeah.
So it's a kind of lose-lose
Pretty
type of
Darwinistic,
situation with this aggressive trade competition, which turns into a war.
How key is Evergrande to all of this? Its shares started trading yesterday once again after being suspended. They closed 28% higher, which suggests people maybe still think there's a bit of time for this to be sorted out. But the key thing is Evergrande has got to find a way to refinance itself, hasn't it? And the authorities at the moment won't let it issue new debt. If it can't issue new debts, then it's finished, isn't it?
Well, I think so. It should be. It's I don't know whether it's the key. It's a key, but in that it potentially serves as a template to what to do with all the other highly indebted property companies, which we're not hearing much about, except occasionally Country Garden. I mean, the problem is much more deep. Goes much deeper than just Evergrande, sadly. And as you say, it's such a tangled mess, and we've got so many different people involved in. A little piecemeal measure here by some local government and there and everywhere. I don't know how you. It really needs to be. I think it needs to be nationalised. I think there's the best expression. And then they just have to do go through all the assets, decide which ones are these under completed building, which ones are going to be completed, and how they're going to be, who's going to pay for that and how. And then do a massive restructuring, which will involve significant write-offs of the debt. So it needs to be. I can't see any other way other than completely dismembering the company.
But it's in everyone's interest, isn't it, if it is allowed to issue new debt and continue with this restructuring?
Well, because I don't think if they're just allowed to issue more paper. This is a difference. People calling for massive fiscal stimulus just stimulus to revive the China economy, but that will not be helped if it's just increasing the pile of debt. You can't until they have debt resolution. That's to say, deleveraging across the system, which requires a number of interventions, including debt write-offs. Some money printing later down the road, but that means probably having a weaker currency. Currently, they're stepping in to stop they're trying to manage the currency to be stable, but I suspect at some point they'll have to let it go down a few notches.
Gentlemen, do you see any international ramifications for Evergrande? With the overseas debt, do you think that could hit the world markets?
No, I think that their dollar debt, offshore dollar debt, trades at a few cents.
Well, there is this hearing on the 30th of September in Hong Kong, isn't there, in which it could be forced into liquidation because there's a group of bondholders who are challenging that in court. The problem is, though, Evergrande doesn't have any assets left in Hong Kong, does it? It's sold its head office in Wan Chai, and
I don't know what it means by. I don't know which entity is being. That's the other thing. I presume there's various all kinds of holding companies and different subsidiaries here, there, and everywhere. So all, that's
It's a complicated mess.
Yes.
Finally, just before we finish, Enzio, let me ask you about the World Bank. Its outlook. It's basically saying Asia faces one of its worst economic outlooks in 50 years. It's downgraded its 2024 forecast for GDP. It expects China's economic output to grow 4.4% next year, down from 4.8% it was predicting in April. And then for GDP growth for developing economies in East Asia and the Pacific, which also includes China, they've cut that to 4.5% from 4.8%. Are you as gloomy as the World Bank on Asia?
Yeah, well, we've been for a long time along with the market. The problem with these multinational, whatever you call them, institutions is they tell you the time by looking at somebody else's watch. And so there's no original thinking other than their surveys and their studies that they do, but none of this is new stuff. So quite why they're coming in and saying, well, gee, I've taken the forecasts, the collective forecasts of Peter, John, and Enzio, and then put them together and said, actually, it's going to be sagaciously 4-point-something%, all this feigned precision.
And then we'll add a bit of a discount, an extra discount.
We'll whack 2 decimal points on it to be a bit gutsy, but it really is telling you the time by looking at somebody else's watch. So they do, and the World Bank does do excellent individual studies on individual topics, but these macro things are really just looking at the time by looking at somebody else's watch.
But you agree overall with the sentiment, even if they're
because
maybe
at some
a bit
point
late.
the higher rates have to bite. It's not different this time. What we were alluding to before, once the U.S. mortgages go off that fixed perch, and then they go up to 7%, of course things are going to hit. So let's wait for a lagged effect. But of course there's also a saying in our broking industry that, John, and you know too well, if you say it long enough, it will happen. So perhaps in the next lifetime we'll have a recession.
The one area where they are optimistic is South Asia. That's sort of India, Pakistan, Bangladesh, Sri Lanka.
As everybody else is. I mean, there's nothing new there. That they've been, India's been going crackers. Indonesia doing very well for some time. I'm sure they're going to also say, hey, Japan is actually on the rebound now.
Okay. Well, it's great to hear your thoughts this morning. Thank you very much for coming in. You heard there Enzio von Pfeil, who's Capital Preservation Specialist at Financial Shield. John Schofield, Managing Director of Tempus Investments.
Peter Lewis's Money Talk.
I'm joined now by Nick Smith, who is Japan Strategist at CLSA in Tokyo. Morning, Nick.
Good morning to you.
Big moves around the world in government bonds overnight. We've been talking about that earlier in the show, particularly in the US, but also in Japan as well. The yield on the 10-year Japanese government bond now almost 0.8%, highest level since September 2013. What impact is this move that we're seeing in bond yields, Treasury bonds and JGBs having on Tokyo markets?
Yeah, I guess that's woken up a few economists. The default state for an economist is to say that things aren't going to change in Japan. And we've had a move. And when I was saying a couple of days ago, there's 23 basis points upside to the yield curve control ceiling at 100 basis points. I said we did the last 23 basis points in 9 weeks, so it's going to be a sexy 9.5 weeks ahead. I think that we'll hit 100 basis points on the 10-year, perhaps by Christmas. But you can see that the buying by the Bank of Japan has tapered somewhat. The shorting by foreigners has significantly increased, and so first of all, that makes you think of the finance stocks in Japan, particularly the banks. They trade around the in lockstep with the Japanese 10-year bond yield, and so that's makes plenty of sense when you bear in mind that the BOJ's basically had its foot on their throats for 10 years. So finally, they've had no EPS growth for 10 years. Now they'll be allowed to do so. Mm-hmm. Obviously, it's got implications for the currency, but I would say no. I think you've got the arrow of causality the wrong way round. That the yen's now pushing on on 150. We know that straight intervention in the markets has historically done next to nothing. So, over the years I've been, since 1990, Japan's done 98 trillion yen worth of intervention, affects usually hours rather than days. And so intervention doesn't do it. The only way of doing it, dealing with things, is by letting Japanese rates drift up, which seems to be what's going on at the moment. I think they'll take out yield curve control at both the long and the short end, quite possibly in January, but certainly by April.
It's a big risk, isn't it, being short the yen at these levels, because all it needs is one statement from Governor Ueda to say that we're thinking about exiting the ultra loose monetary policy sometime in the near future, and the yen is going to shoot up.
Well, I think that's the case at the moment, and the frustrating thing is that the BOJ has certainly not been a good communicator recently. So, each time it's made the move, it's defied expectations. I must say, I on both of the times it's moved yield curve control ceiling, I was saying they're going to move it up, but I think the market was frustrated about the lack of good communication.
I mean, this is all brilliant, though, isn't it, for the Japanese equity market? You've got interest rates that are negative, real rates very low. The exchange rate has plummeted. Great for Japanese stocks. What are they up about 25% so far now for 2023?
Yeah, in yen terms, they're done very well. So if you're a smart guy like Warren Buffett, you finance with issuing yen bonds, then you're going to have a great Christmas. Yeah, I think I certainly rub our clients' faces in the story that I'm paying 0.345% on my mortgage. What are you paying? And that's in a cut. And that's in a country where inflation, ex fresh food and energy is 4.3%. So money is slightly cheaper than free. So it'd be churlish not to take advantage of it.
I mean, the irony is inflation in the US is actually lower than it is in Japan, isn't it? Whereas if you looked at interest rates, you would never believe that.
Yeah, I mean that's the one thing you really don't hear from the journalists is that all the fuss they're talking about inflation elsewhere. It's actually higher here in Japan. But the trouble is, of course, that wages haven't moved in Japan for 30 years, so it's really weighing on the support rates for the government at the moment, and they'll pass that pressure on. The central bankers always like to pretend that they're engineers, but they're really ultimately at the whim of politicians, and the pressure ultimately gets fed through.
The other statistic that I'm interested in, that I saw you quote in your recent report, the Japanese market cap, it's about 5% of global market cap. It used to be over 50%.
Well, it did, and so you see these ridiculous charts in the papers where they say, "Well, Japan hasn't got back to where it was in 1989," and of course, anyone who was there at the time says, "No, that was La La Land at the time. It was absolutely fantastic fun, but it's probably the biggest bubble in human history." And so, in terms of equity prices have come down, profits have come up, and now they're very much backed up by earnings, which wasn't the case before. I mean, the Schiller uses his price to 10-year average earnings and says, well, the US is expensive at 30 times. And I go, yeah, but in 2005 we're trading at 120 times in Japan. So basically the market was being held up by brokers hyperbole, and luckily we got away with it and kept our jobs.
Yes, I remember those were the good old days, although what Japan's doing at the moment might create a new bubble.
I think if you wanted to create a bubble, this is how you would do it. I mean, giving money away in quite the way that they're doing with banks at the moment. I mean, when I signed my mortgage contract, there was 7 of the bankers sitting at the table in front of me, and I'm going, that's just wiped out all of your profits on this for 10 years into the future. I mean, ultimately, I think lending at these rates is just inviting problems for the future. But with a little luck, we'll be on our beach with drinks with umbrellas in by then.
And presumably now that Japan is out of deflation, this is good for Japanese companies, and it's good for their profit margins.
It is. I mean, I saw some delightful economist being interviewed on television, and he was being asked, what's so bad about deflation? The prices coming down is a good thing, isn't it? And the poor dear couldn't explain himself. But obviously that crushes the profitability of companies, and also makes their debt bigger and bigger. And so they cut their spending to bring their debt down. That causes supply and demand to fall apart, and prices drop further, makes their debt bigger, and you go into a vicious circle. So, I mean, deflation is like the sort of the Schwarzschild radius around a black hole. Once you get inside, it's really difficult to get out of it. Japan's managed to get out of it. Not everyone should assume that if they get into it, they'll be able to get out so lightly. But yeah, thank God we're out of that. And the result is that profitability has exploded upwards. So I show a chart of profitability going back to the 1950s and say it always peaked at in previous cycles at half the level it's at the moment. I'm not saying it's good; it's still lousy, but it's at least double what it was in previous cycles. And I think the escape from deflation is a major part of that.
This is almost the perfect holy trinity, isn't it, for Japan? You've got profit margins increasing, earnings increasing, forecasts for the economy being revised up, a weak currency. It just seems that everything is in favour for Japanese stocks at the moment.
Yet we've got people profit taking at the moment. I mean, I think the situation's reasonably good. You've always got to keep in mind that this is a deeply cyclical market. I believe that there's enough from the country belatedly coming out of hibernation to cushion us from the global situation. But global growth has slowed, and the situation from here is all down to whether you think that the US has a hard or a soft landing, but this time around, China's not going to bail us out.
How exposed is Japan to the slowdown in China?
A lot of people seem to think, it's all Asia. They're interlinked. If you look at it, the Chinese GDP forecasts have been slashed this year. The GDP forecast for Japan's been significantly lifted. Same's happening with profit forecasts, consensus forecasts for Japanese earnings. They're getting revised up day by day. The numbers keep going up. What I find is people misunderstand the GDP numbers that show trade between Japan and China. Of course, the trade between Japan and China is basically Japanese parent trading with Chinese subsidiary. But if you want to sell in China, you make in China. Otherwise, what you send to China is stuff to snap together and send to rich countries in the West, like North America and Europe. So ultimately, the really important thing is North America, and it doesn't make so much money in Europe, but Bidesa ex-China is hugely important also. I think people overestimate the importance of China in the profit mix for Japan. Not for Germany, but certainly for Japan.
And what sort of state is the Japanese consumer in? In China, the consumer is pretty gloomy and is really pulling in the horns. What's the Japanese consumer doing? Because if I look at the PMI numbers that came out at the beginning of the week, they look pretty good, don't they?
They do. So if you listen to economists, and I had general advice against it, they're pretty negative on Japanese consumption. I look at the consumption monthly series and say it's got a hell of a lot of upside to the average for 2019, even more upside to the long-term trend. It's depressed at the moment, but usually you look at the manufacturing PMI. This time, I think I'd recommend, because of reopening, to look at the services one, and that's surprisingly strong. That suggests to me that there's some very positive things in the pipeline for the service sector, and therefore, I suppose, ultimately for consumption in Japan.
And also, what about Japan's demographics? We're hearing a lot about demographics from the World Bank at the moment. They're pretty gloomy on China, very positive because of good demographics in South Asia, in India and Bangladesh and Sri Lanka. Japan's got a shrinking sort of population. What's the impact of that?
Yeah, I mean, economists, bless them, think that if only the world had more people. Obviously, in was it 1932, the world had 1 billion by had 2 billion by 1970s. It was it 1973? It got to 4 billion, and now it's last November it passed 8 billion people. Think of that report from Oxford University saying 47% of US jobs are vulnerable to automation and AI. Will obviously population is increasingly a millstone, not a merit at the moment.
Okay, well, Nick, it's always good to talk to you. Thank you very much indeed for that. That's Nick Smith, who is Japan strategist at CLSA in Tokyo.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening to Money Talk this morning. You can find more business and finance information from around Asia in my daily newsletter, which is at peterlewismoneytalk.substack.com. I'll be back tomorrow when I'll be joined on the show by Andrew Ferris, the CEO of Econosis Advisory, and Peter Kim, Managing Director and Investment Strategist at KB Securities in Seoul. With a view from Taiwan is Ross Feingold, Business Development Director at SafePro Group. See you tomorrow.
Money Talk.